Monday, 7:15 a.m. You're at your desk job by 9, same as everyone else. Badge scan, coffee, inbox. Nobody in this building knows that you think about money completely differently than they do. Your coworkers save what's left over at the end of the month, if anything is left over at all. You don't operate that way. You operate like a fund. Every paycheck gets split before it ever reaches your checking account, a fixed percentage moved out automatically. And that percentage isn't savings in the way most people mean it. It's deployable capital. You've started thinking of yourself not as an employee with a savings goal, but as the general partner of a very small fund, and the fund's only investor is you. Monday, lunch break. You spend your lunch reading, not the news, but a filing. You do this most days. Venture capitalists don't pick investments based on vibes. They pick them based on theses, a specific belief about where value is going to accumulate over the next several years, backed by research they defend under pressure. You've built 4 theses for yourself. One around infrastructure that supports artificial intelligence, not the flashy consumer apps, but the unglamorous companies underneath them. One around a sector you understand personally because you've worked adjacent to it for 6 years and can spot nonsense faster than an outsider could. Each thesis gets a small, deliberate allocation, sized so that being wrong about any single one doesn't touch the others. Tuesday. A position you opened 8 months ago is down 40%. In a normal investing mindset, this triggers panic. In a venture mindset, it triggers almost nothing, because you never expected every position to work. VCs don't expect most of them to fail completely, a smaller number to survive, and 1 or 2 to return the entire fund and then some. You built your portfolio the same way on purpose. 12 positions, most of them modest, none of them large enough to define your future by themselves. The one that's down 40% was always going to be one of the ones that might not make it. You didn't invest in it expecting certainty. You invested in it because if the thesis played out, the payoff would be large enough to make 11 other quiet losses irrelevant. Tuesday, later. A coworker sees your screen over your shoulder in the break room, notices a red number, and asks if you're okay. You laugh. Actually laugh, because the question assumes a red number is automatically bad news, the same assumption you used to carry yourself before you started thinking this way. You explain, briefly, that you expect most of your positions to look like this eventually, that the entire structure only needs 1 or 2 of them to work, not all of them. He looks at you like you've said something slightly insane. Most people have never had a framework explained to them where being wrong most of the time is not just acceptable, but expected, built into the math from the very beginning. Wednesday, 6:30 p.m. After work, you do what you think of as portfolio review, the same ritual a fund manager runs at the end of a quarter, except you run a lightweight version of it every week. You're not checking prices for the thrill of it. You're checking whether the thesis behind each position still holds. Did the underlying story change? Did new information come out that should update your confidence? Most weeks, nothing has changed, and you do nothing, which is itself a decision, not an absence of one. Doing nothing when the thesis is intact is exactly what discipline looks like from the outside, even though it looks identical to doing nothing out of neglect. Thursday. A position from 14 months ago, a small allocation you almost talked yourself out of making because the argument felt slightly too early, is suddenly up 210%. You don't sell all of it. You trim a piece, enough to bank a portion of the return and remove your original capital from the table completely, and let the rest ride uncapped. This is the part almost nobody outside of venture thinking understands intuitively. The gains that actually move a portfolio rarely come from the median position. They come from the outliers, the 1 or 2 bets that work so much harder than the others that they end up carrying the entire return on their own. Your job was never to be right about everything. Your job was to be positioned for the few times you were right about something enormous, and to survive comfortably every time you weren't. Friday, you get your paycheck. The automatic transfer moves out before you even open the direct deposit notification. Your coworker mentions in the break room that they're thinking about picking a hot stock they saw mentioned online, something with no thesis behind it beyond the fact that it's been going up. You don't say anything discouraging, you've been there, but you notice, quietly, that the difference between what you're doing and what they're describing isn't intelligence, and it isn't access to information they don't have. It's structure. You have a portfolio built to survive being wrong most of the time. They have a single bet built to feel exciting for exactly as long as it's working. Saturday. You do the unglamorous work nobody sees. You update your tracking sheet, not to celebrate anything, but because a fund with no records isn't a fund, it's a hobby. You note which theses are aging well and which ones you're starting to lose confidence in. One of your 4 core theses, the one you were least sure about from the beginning, hasn't produced any signal in either direction for almost a year now. You make a note to reduce that allocation at your next rebalance, not because it failed loudly, but because a thesis that goes quiet for too long usually means the timeline was wrong, and time is the one resource even a fund of 1 can't get back once it's spent on a position that isn't going anywhere. You also review your cash reserve, sized deliberately so a bad month at your actual job never forces you to sell a position at the wrong time. Real funds keep dry powder, so do you. Sunday night. You sit with a notebook, not a spreadsheet, a plain notebook, and you write down one new thesis you've been circling for a few weeks, an idea about where the next few years of value might accumulate that you're not fully confident in yet. You don't act on it, not yet. VCs sit on ideas for months before deploying capital into them, waiting for conviction to either build or quietly fall apart on its own. You close the notebook. Tomorrow you go back to the same desk, the same badge scan, the same job that pays you a salary that has nothing to do with any of this. Nobody in that building will ever know that outside of work, you're running a fund. The only difference between you and the people managing billions is the number of zeros, and the fact that they're doing it because it's their job. You're doing it because you decided, a long time ago, that the size of your paycheck was never going to be the ceiling on how you thought about money. Somewhere tonight, someone just made their first investment based purely on a stock going up in price this week. No thesis, no portfolio, no plan for what happens if it goes to zero. They have no idea there's a completely different way to play this game, one that doesn't require quitting a stable job or having access to anything they don't already have. It just requires thinking like an allocator instead of a gambler, starting with the very next paycheck.